1960s, economists were very optimistic about their ability to model the economy. They began to develop large-scale models. This work was done at MIT, at Penn, at Brookings, at the Fed. And the Fed, although use of these models in academia fell out of favor, the Fed really needed these models for the work that we do, and work continued developing this model. And so Frb is an intellectual descendant of those early models. And they have some of the characteristic that you described. So first of all, they tend to have sticky wages and prices, and therefore they do not in any way force the economy to be operating at full employment at a given time. And they do have a long-run growth path. I don't know that I'd say it's exogenous, but it depends on technology and capital accumulation and other long-run factors. And there are mechanisms at work through movements in wages and prices and possibly monetary policy responses that would bring, as you said, the economy back to that growth path. But let me just say that models that we use, that process can be very slow. And importantly, when the economy hits the situation that prevailed starting in late 2008 in the United States and then in many other countries, we had lowered short-term interest rates to zero. So monetary policy was constrained by the so-called zero lower bound. We have found out you can cut interest rates a little bit below zero, and some countries have done that, but we typically think of zero as low as short-term interest rates can go. Then the natural equilibrating mechanisms that are operative in those models are very, very slow. And so they have the realistic property that without some policy response, the economy can be away from equilibrium for a long time. We have other models that have been developed, a kind of model that's become very popular in recent times called DSGE, or Dynamic Stochastic General Equilibrium models, that are micro-founded and fully optimizing, and we have a variety of those models. But then let me say, for actual forecasting, and that is a critical part of what we do, we don't really rely on any of those models. We take their insights, and then we use a variety of tools and judgment to try to forecast what the path of the economy is going to be over the next couple of years. And one of the things that you find when you use a model in forecasting is that there will be mysteries at any time. You will have some key equation, an equation, say, forecasting consumer spending. That's 2/3 of spending in the economy. And maybe the model equation says consumer spending mainly depends on income and wealth, and then you find out it doesn't fit. And, for example, after the financial crisis, consumer spending was just very depressed, period after period after period, relative to what any consumption function would have predicted. That becomes a mystery that commands the attention of our economists, and they will spend a lot of time trying to figure out, are there special factors in play? One of the things that we found was surveys made clear that consumers' expectations about their future income, which of course is relevant to consumer spending, fell dramatically after the crisis, and possibly for good reasons. You know, we remember after the Depression, attitudes of the public toward investing and toward risk changed discreetly in ways that were very long-lasting. And there was the models didn't give households any good reason to believe that their incomes would remain depressed that long, but that seemed to be what was going on. And so we try to look into that. And then finally, I'd say, we don't just use models. we also talk to people. And one of the virtues of having a central bank like ours, which is dispersed throughout the country, we have 12 regional reserve banks, is we have a wide range of contacts in the community: businesses, households, labor, people, nonprofits who are operative in the community. And we talk to them on a regular basis about what we're seeing. And sometimes one learns, sometimes you don't learn things from that, but sometimes you learn things that are very important that you would otherwise miss and that would not appear in models. And so I will always remember, for example, the year leading up to the financial crisis, when my contacts, of course, we were all focused on housing and the fact that housing prices were very high and the dangers that that could cause. But my contacts, my business contacts in that year kept saying, money is available for absolutely anything. Banks are throwing money at anything without really seriously looking at the prospects. And people said they had never seen anything like it in their lifetimes. And I will always remember particularly an anecdote. I had a director who was a principal in a private equity firm, and this crystallized for me. He told me a story about how his firm was contemplating bidding on a major U.S. company, taking it private in a leveraged buyout. And there were quite a few private equity firms that were also looking at this firm, so it was going to be quite a competitive situation. And he first said to his partners, "This is impossible, there's no way we can win this." And his partner said, "Look, just sit down and write out what would you have to have in order to be able to win this bid, and then go to talk to some banks and see if they're willing to give you loans on these terms. You're going to have to throw a lot of debt into this to take this firm private." And they wrote it down. It was just incredible. And they said, no bank's going to give us terms like this. You'd need a huge amount of leverage. If the economy hit as much as a pothole and its income fell for a year or two, it might not be able to make the payments on this huge amount of debt. So you would actually need a feature in this debt which allowed you to just forego paying the interest, and this was called payment in kind. You would just add on to the outstanding debt if you couldn't pay the interest. And they went to some banks, and they found that banks were just falling all over themselves to give these terms. And they ended up winning this and taking this company private. And this thing, which was called the PIC toggle, became this feature I described, became a common feature of debt contracts. And of course, what was going on is that the banks were packaging these loans, and they were selling them to investors who wanted safe assets with very high returns that you can't get in, for example, a U.S. Treasury. And, this was like bells going off. Now, unfortunately, this was too close to the financial crisis, and it really wasn't information that we could use to address what lay ahead. But it was information that didn't come from models and provided insight that, I think real policymakers want to be taking account of.
So use many models, but listen carefully, because there are a lot of things out there that matter like mad that the models aren't picking up.
That's right. And the motivations that people have often come across to you or give you things to really think about what is going on, why would people be behaving in this way. And none of this is in our models.
And had we done that better, we'd have been collectively better at anticipating what did in fact happen.
Well, I think we would have been, unfortunately, these insights were a little bit too late. I'd say now, in the aftermath of the crisis, we're trying to do things like that in a more systematic way. We've started up a new division that focuses on financial stability. And the people who work in that division at the board and in the reserve banks, we really ask them to go out and think outside the box. Talk to people in different pieces of the financial sector. Think about all the things that could conceivably go wrong that are not in models. Be contrarian in your thinking. Write down all of the risks, and let's see where that goes. And so, that is a lesson, I think, from the crisis.
Let's pursue that a bit, but move to the second question, which is around where those big traumas can come from and the inherent instability of banking systems. And basically, it's very simple. You go and give your money to a bank, and the bank promises you can have it back any time you like, and then it goes and puts it long-term on a bet, which is called an investment project or whatever it might be, buying a house. And it's what our friend Mervyn, who's here, has called essentially alchemy, that the promise is that you can have it back any time you like. It really is gold, and they've got it, and they'll give it back to you. But it isn't, because it's been used in a different way, which is inherently illiquid. And therein lies the instability of a bank. And that won't go away, because it's in the logic. If we had perfect markets into the future where we could hedge against absolutely everything, then you could take most of that risk, or in principle, if they were perfect markets, you could take all of that risk out. But you can't, because those markets don't exist. You can't transact for every good at every point in time in the indefinite future, which is what you'd have to do. So we got ourselves into a position where that risk, which is inherent, was sort of pumped up and became extreme. So you have to ask yourself the question, what can we do? Or have we done enough to reduce the probability of those kinds of risks which we recognize as inherent?
Well, let me just say, I'm delighted to see Mervyn here. I'm honored that you've come, and Mervyn has written a brilliant book about exactly this and the kinds of things we can do. And, of course, every financial crisis has the same character that you just described. It's essentially a bank run, a situation where the financial sector is borrowing short-term and investing in much less liquid or highly illiquid assets that can't be liquidated, and it is telling depositors or those who are lending short-term, anytime you want your money back, don't worry about it. And that works fine as long as not too many people want their money back at the same time. And that's typically the case as long as there's confidence in the soundness of those institutions. And when that disappears for any reason, suddenly all the missing markets and imperfections you're talking about, if I see depositors lining up around the block of one bank, and I know it has problems, how do I know the bank on the next block didn't invest in exactly the same things and may have exactly the same problems that are about to come to light? And so you have a situation of contagion, and essentially you can get a massive run on the entire financial system. And that's really what happened in this that's what happened in the Great Depression. That's what's happened in every major financial crisis. And in this financial crisis, the runs were centered partly in banks, but not so much in banks, also outside the banking system in a sector we call the shadow banking system. And we threw into place. Mervyn and my predecessor, Ben Bernanke, were immensely imaginative. Society should be grateful that they were there to think through how can we intervene and to provide the liquidity that's necessary to these markets so that credit doesn't dry up in the economy. Well, in the aftermath, you asked, are we safe? I think you asked me, are we safer now? So we have been very focused on making sure that the core of our financial system has enough capital that we can provide assurance that our major banks would be able to go on lending and providing credit to the economy, even after a very severe shock. We do what are called stress tests. And the Fed just completed the first half of these stress tests last week. And we hit the major banks that we subjected to these stress tests with enormous shocks. Unemployment increasing to 10%, huge declines in house prices, commercial real estate prices, enormous shocks, and publicized exactly how each of these firms would fare and what losses they would take in every portfolio and what their capital position would be at the end of that. And I think the public can see that the capital positions of the major banks are very much stronger at this point. This year, all of the firms passed the quantitative part of the stress test. And so we've built capital, we have strong capital requirements, also liquidity. So suppose there were a scare and depositors decided we want our money, we're worried that there's something wrong in your bank. Well, having enough liquidity that you would be able to meet deposit outflows that could occur, let's say, over a 30-day period, even if they were severe, we've put in place for systemic banks, internationally active banks, liquidity requirements that hold in order of magnitude more liquid assets. And we've also changed the system in terms of how derivatives work. Now, most standardized derivatives are centrally cleared rather than being involved in complex webs that are very difficult to untangle when a major institution gets in trouble. So the architecture of the system has changed in important ways that's made it safer. We've put in place reforms for money market funds. There were runs on money market funds that had fixed net asset values. In other words, $1 of deposit, you would always get $1 back. We're forced major institutional funds that hold other than government paper essentially to have variable values, which tends to inhibit a run. So I think the system is much safer and much sounder. And as I mentioned, we're doing a lot more to try to look for financial stability risks that may not be immediately apparent, but to look in corners of the financial system that are not subject to regulation outside those areas in order to try to detect threats to financial stability that may be emerging. So would I say there will never, ever be another financial crisis? Probably that would be going too far, but I do think we're much safer, and I hope that it will not be in our lifetimes, and I don't believe it will be.
So regulate more toughly than we had been, a lot more toughly than have been, and smarter, and listen more carefully to what's happening out there. And you can bring the probability down somewhat.
Yes.
And probably then also, it wouldn't be a particularly good idea to move back and unwind that wise regulation that we've now put in.
So I don't think it would be a good thing. I sometimes we're now about a decade after the crisis first hit, and memories do tend to fade. So I hope that that won't be the case, and I hope those of us who lived through it will remind the public that it's very important to have a safer, sounder financial system, and it is essential to sustainable growth. Now, I mean, I would say in the case of the Fed, and this is probably true in other countries as well, over this last 7 years, we have written many regulations to improve things, and some of them are very complicated. And I do think that regulators should think about the burdens that they're imposing on those who are regulated. And we hear consistently in the United States that especially for smaller banks, for community banks, now they're not subject to the same regulation that systemic firms are. But in general, that looking for ways to reduce regulatory burden, but without in any way compromising stress testing, capital, liquidity requirements that have done a lot to make the system safer.
Very good. Janet, I'm keeping an eye on the time, so we probably should shift to our second line of inquiry, which is a bit less about models. So probably the more technical bit is over, you'll be very pleased to know. And this is now more about the way that economists and policymakers look at the world. And I want to go back to the period around the end of the, or maybe the beginning of the 80s, where we had on both sides of the Atlantic governments that were focusing on, I think probably in their own kind of language, restoring the powers of the markets, reducing the powers of the unions, deregulating across a whole swathe of economic activity. And then at the end of the 1980s, we had the collapse of the Soviet Union and the regimes of Central and Eastern Europe, and a kind of triumphalism that the free market economy has shown its tremendous power and strength, and the other way of doing things has collapsed. It's true that the other way of doing things had collapsed. And so we had a sort of continuing wave of deregulation, the idea that, in Bob Solo's language, all that exists is efficient, because were it not efficient, it would not exist, the fundamental Chicago theorem. Except, of course, if governments interfere and mess it all up. And I don't think I'm exaggerating. That was a kind of basic approach which some economists and some politicians fed off each other. And I think in retrospect, and I'm saying this, Janet, I'm not trying to put words in your mouth, we sowed some of the seeds of the crisis that came later, you know, following the kinds of arguments you were putting earlier. In the words of our dear friend Tony Atkinson, who died at the beginning of this year, in his view, Tony's view, our subject lost its way by, as it were, overdoing its devotion to the first-year economics course that we teach our students about the efficiency of competitive equilibrium and so on. And do you think we're doing better than that now? Are there bits of our subjects, behavioral economics, institutional economics, which would make it less likely we'd feed a very particular line about the damages of governments do and deregulate, the importance of deregulation and so on?
So let me start by saying, first of all, I agree with you that we did go through a long period in which the free market works perfectly, and brand of economics that didn't focus on market failures, market imperfections, but was very much oriented toward markets work well and government messes it up. that was important, not just in the UK, but also in the United States. With respect to, for example, bank supervision, I think it's fair to say that in the years before the crisis, supervisors had gained comfort with the idea that CEOs knew how to manage risk in their firms and were motivated and had every reason to do it, that market participants who bought, for example, bonds of financial firms that where there could be losses would be motivated to provide a kind of market discipline on risk-taking. There was some confidence in that. It was a phase in which in bank regulation and bank capital regulation, we realized, well, you can have a set of capital regulations where you take different assets and you say this kind of asset you have to hold 20% capital against, and that's safer, and so you can hold 10% capital against that, and so forth, and say, well, gee, that's not really very risk sensitive. The banks are developing models that are much more risk sensitive for use in managing themselves. So let's leverage off what the banks are doing and use their models to figure out how risky they are and how much capital they should hold. And this became embodied in an agreement called Basel II, and to some extent is still in effect, although not really in the United States. And so there was the idea that the firms are very smart, they know what they're doing, we can leverage what we do off it. Also in areas where there were people who had suspicions that there could be problems like derivatives markets, we passed up opportunities perhaps during that time to put in place safeguards. Well, the financial crisis certainly showed that this was an approach that could lead to serious breakdowns. We saw during the financial crisis that even the most sophisticated firms really failed to understand the risks, the enormous risks that were present in their own balance sheets. They were not doing a good job of building models to assess risk, and probably they were using, to some extent, these models to try to lower their capital requirements. And they had set up incentives in their firm for risk-taking among their employees that created enormous divergences between what the employees were motivated to do and what was in the best interest of the shareholders. And while derivatives flourished, a risk with derivatives is that it's always potentially attractive to sell out of the money puts. You take in a lot of insurance premiums, and if nothing happens, you do extremely well, and if something happens, well, perhaps you go bankrupt. All of these things played a role in the financial crisis, including AIG, that had been the hugest seller of out-of-the-money puts in a sense that, unfortunately, it did come home to roost and almost took down the financial system. So these ideas did lead to a period of deregulation. I think the other thing that I would say about that period, from the mid-'80s up to the financial crisis, there was a period that macroeconomists often refer to as the Great Moderation. Economies, most advanced economies, were pretty stable. Macro performance was good. Inflation, which had been very high in the 70s and brought down in the 80s, it was pretty low and stable. Central bankers were kind of patting themselves on the back that they understood how to do their jobs, and they had developed frameworks that worked. And I think, many people thought, business cycle, we've figured all this out, it's fundamentally dead. And perhaps that was a problem also for individuals who thought, you know what, this isn't a very risky environment. And perhaps that whole environment was one that encouraged undue risk-taking, especially with low interest rates, people searching for yield. And now, of course, after the financial crisis, those who see the danger in that type of thinking have played a major role in ensuring that we have a more appropriate system of supervision and regulation. And hopefully that will remain in place for a good long time.
I hope so. One guarding against that kind of fundamentalism, and it was also followed by complacency, as you described, is the way we think about things. And you mentioned market imperfections, and market imperfections are things like monopolistic structures, or when my action damages you, emissions of greenhouse gases comes to mind. Those kinds of things that we push ourselves to think about help us avoid these kinds of mistakes. But there are two branches of economics, I think, which have been helpful, and I hope, and it's a question really, would mitigate that kind of fundamentalism and complacency again. One is behavioral economics, one is institutional economics, that people don't necessarily behave like the fully informed, perfectly calculating, total foresight individual, self-interested of course, that we offer up to our first-year students. It's just possible that people don't behave quite like that, and particularly psychologists and others have come to help the economists understand a bit better, and I think there's been very good economic work in that area to help people change things, and it's led to actually quite serious policy changes. We had the so-called nudge unit in number 10, which was a good idea in my view. And institutional economics, the way in which the structure of institutions and how people behave within institutions can influence outcomes, sometimes lead you to mistakes, and they're well done, avoid, and help people to collaborate better. So those, I think, have been big, strong moves in our subject. If you look at what people publish on, do research on, they do work in those areas. And the more seriously we take that kind of thing, I think the less danger we have of the simplistic intellectual slides that we took earlier.
Well, I would completely agree with your assessment. I think behavioral economics has provided a lot of insights in the United States. As you said, this has led to policy innovations. In the United States, for example, the observation of Richard Thaler and co-authors that the amount that people end up saving depends importantly on default choices they make that could go one way, they could go the other way. You sign up for a firm, they have in the US we would call this a 401k plan. You can make a contribution tax-free. If you do it, let's say your employer matches it, and you stay in it and begin to build wealth. It used to be pretty standard that if you were hired by an American firm, you were told about these arrangements. This was part of what was in your employment package. And anytime you wanted to sign up, you could go sign up. Now, I will confess that I was in one of these plans during my days at Harvard as an assistant professor. And I could leave you to guess, what day do you think I signed up and made a choice for this? It was my last week before I left, and I always felt very embarrassed about that. But then I found there had been a study that had been done, and I was not alone. 75% of assistant professors had done that. So then you say, well, okay, and this is what Thaler and his co-authors did. They say, suppose instead of the default being you're not in unless you sign up, the default is you're in. We're just going to enroll you in this. And if you don't want to be in it, you can pull yourself out. Well, what they found is this made just an enormous difference to the amount that people save. what the default choice was, and this has really now become quite commonplace. Beyond behavioral economics, I agree with you that institutional economics, and I think bringing sociology, I think a lot of motivation of people in the economy and in organizations and understanding how they function comes down to sociology and how people interact with one another and form values, identities, loyalties. That's not something that's captured really in behavioral economics, but I do think sociology and economics, which ties in with institutional economics, has the potential to provide a much richer set of models and theories for our field.
And wiser policy too, I think.
And wiser policy too.
Good. Now, before we go on to just spend 10 minutes on what's going on in the world, before we open up to questions, another area of economics that's changed a lot is the very intensive use of big data. And that's been used in all kinds of ways. I mean, it's almost like the epidemiology approach to economics. Take lots and lots of data and then look around inside in a sort of sometimes crude way, but more and more sophisticated ways. Do you think that's got a lot to offer macro?
So I think it does have something to offer macro, and our statistical agencies have large programs trying to make use of big data to enrich the series that they produce on a regular basis. But while it has a lot of potential, I would say it also has some limitations that's useful to be aware of. And I guess let's think about what are the strengths of our traditional system of producing statistics, our government agencies, and the series that they produce. First of all, the only job that they have is to produce data for users like the Fed and the private economy. The data that they produce, it's not something that happens to be generated by another activity that's the core focus of the business. They're careful about measurement and careful to put together samples that are representative of the population as a whole. I don't believe in measurement without theory, and so what should you measure? Our statistical agencies have thought pretty hard about what to measure. And so, for example, there's a theory of the cost of living that economists have developed, and that guides the work on the construction of things like the Consumer Price Index. There's a couple of people who won Nobel Prizes for their work on national income accounting, and the design of the national income accounts reflects theory in the work of individuals like Simon Kuznets. And they produce long time series that are methodologically consistent. Okay, big data, everything I listed is an advantage. It's not true with big data. You don't have long samples. Often you have some huge data set that's become available because it's generated by the work of a company. Sometimes you have a couple of people in a company who see the potential for research and are really committed to developing the data for use. And if those individuals leave the firm, there's no more commitment to it. They're not representative. So there are shortcomings, I think, that people don't often realize about big data. But what's great about it is that anything that doesn't rely on a long sample and does rely on real fine detail to understand something, these data sets can be immensely helpful. So, for example, with the Fed, we've been interested in questions like what is the marginal propensity to consume out of savings in gas prices, and able to use very huge data sets to get enough leverage because of geographical variation to try to get a handle on things like that. So it's already been useful, but it's not something that we should say, statistical agencies, your day is done and we don't need you anymore.
Very good. So let's just spend a few minutes on the last part, and let's focus on technology and work and productivity. To some extent globalization, but globalization, I think certainly in my view, is overdone in terms of the influence of its effects on the kinds of things that we're worrying about relative to the way in which technology and the nature of work have changed. And we seem to be in a world where technical progress, from some perspectives, has never been faster. I mean, the digital economy, materials, graphene and all sorts of others, biotech and so on, it's quite remarkable. You've got almost a number of industrial revolutions interweaving and happening at the same time. But also we have an economy where our indices of productivity don't seem to look all that good. Increasing number of people doing rather sort of contingent, independent jobs where for many of them that independence probably wasn't sought. I mean, your lawyer or a doctor might have sought their independence, but a lot of other people now in that kind of business of doing bits and pieces here and there. So what you've got are these dramatic changes in technology. You've got 500,000 jobs have been lost in US retail since the turn of the century. That's not globalization, that's different ways of doing things. So you've got these extraordinarily exciting and productive technological change and all sorts of changes in people's working lives, not everybody of course, but in many people's working lives which make them more precarious. We don't seem to pick up the numbers in productivity. The precariousness seems to be genuine if you look at correlates like mental health and so on. So are we missing something? Should we be doing much better as economists in our understanding of what's really happening and as policymakers in terms of managing what seems to be rather fundamental change?
So that's a very big and important set of questions. I would say that what we've seen in recent decades is the offshoring and automation of middle-income jobs that involve anything routine that can either be done by computers or over the internet, or can be done in other countries where wages are lower. So you mentioned globalization and technology and said that you think technology is more important. I think I would agree with you, and I think that's what most economists find. But it's frankly hard to separate these two things. Technology and develop of the internet and reduced communications costs have certainly made it possible for multinational firms to invest all over the world to break up value chains and to move production to a more complicated global system. And so the influence goes both ways between technology and globalization. There's no clear dividing line. But I think both of these things have, at least in the United States, and I think this is generally true in advanced countries, been quite harmful to a very large share of the population. So we have increasing wage inequality, income inequality. We've had a disappearance of middle-income jobs, sort of job polarization in which the gains are actually fastest at the bottom of the wage spectrum and at the top. Globalization, I think, mattered. There are a number of studies for the U.S. that shows that China's growing trade negatively impacted workers in the United States. and they've taken those.
We're going to break out of the conversation there between the Fed Chair Janet Yellen and Lord Nicholas Stern. It's taking place in London. You can continue to watch it at TV Go on the Bloomberg. Some breaking news to report. The U.S. Senate is set to delay a vote on the health care bill until after the July 4th recess. I want to bring in Bloomberg Chief Washington correspondent Kevin Thriley. He joins us now. Kevin, what led to this? And I understand there's a meeting set to take place at the White House a little later this afternoon.
David, breaking news. Senate Majority Leader Mitch McConnell reportedly now delaying the vote until after the July 4th recess to have a vote on health care here in the Senate. He is facing, quite simply, math that doesn't add up. He has opposition from the far right of his party, as well as more moderates. People like Senator Rand Paul, Ron Johnson, Ted Cruz, Mike Lee, all opposing the current form of the proposal put forth by the Majority Leader, saying it's not conservative enough, that this was not what they had campaigned on to deliver to grassroots conservatives. Then you have moderates, people like Senator Susan Collins, Senator Lisa Murkowski. David, they were apprehensive to even bring this to a vote. And then, of course, Senator Dean Heller, the Republican up for re-election in the state of Nevada, saying that this, again, is just not the type of bill that he could get on board with. The math isn't there. They could only afford to lose 2 Republican senators. They had already lost at least more than 6, likely even anywhere upwards of 12. David?
I'll pick up, Kevin. It's Anna here in the studio. Where does this leave us on the timing then? Because this timing was imposed by the administration themselves, wasn't it? I mean, they wanted to have this vote this week to move on to other matters. They're not going to be able to do that.
Talk about an artificial deadline. The Senate likes to say they can walk and chew gum at the same time, but this is an example where they're going to have to once again kick the can down the road. They're going to wait until after the July 4th recess. But look, there's a lot of hope from the financial services sources that I talk with here in Washington that they might be able to do something on tax reform or juxtapose, forget about health care, juxtapose tax reform with some type of infrastructure plan. But that's a really optimistic policy perspective to take simply because of the divisions within the Republican caucus on infrastructure. So look, later today, President Trump calling all of the Republican senators to meet at 1600 Pennsylvania Avenue. They're going to be loading up the buses, rolling down the street there to the White House. We'll be right there with them, and we'll have to see if there's any breakthrough. It's